Mortgage rates just slid to about 6.26 for a 30-year fixed loan. This is the lowest level in almost a year. This happened right after the Federal Reserve trimmed its main interest rate by a quarter point, and officials have hinted at a couple more cuts later this year. It's very encouraging news, but what does it mean for your monthly payment? To find out, we need to understand how mortgage rates are actually set. The Fed's move affects short-term borrowing between banks, not directly the 30-year home loans people take out. When the Fed cuts rates, it's lowering the federal funds rate, which is essentially the overnight interest rate banks charge each other to meet reserve requirements. This step guides the broader economy, but it doesn't directly dictate mortgage rates. In fact, the Federal Reserve doesn't set mortgage rates outright at all. It only influences them indirectly through economic conditions and expectations. Home loan rates depend on the U.S. bond market, especially the 10-year U.S. Treasury note. The Treasury issues bonds, basically IOUs, that pay interest and return the principal at maturity. The 10-year Treasury is popular because it's low risk and long-term, so its yield, interest rate, is a key benchmark for long-term loans like mortgages. When the 10-year Treasury yield goes up or down, fixed mortgage rates typically follow in the same direction. Another factor is the market for mortgage-backed securities, MBS. Banks and lenders bundle thousands of home loans together and sell shares of these pools to investors. Those investors receive income from the homeowner's monthly mortgage payments. The interest rate that investors expect from MBS, compared to safer Treasury bonds, influences what rates lenders offer to borrowers. In practice, mortgage rates generally equal the 10-year Treasury yield plus an extra margin, or spread, to compensate for the added risk and cost of MBS. This is why your mortgage rate is usually higher than the 10-year Treasury yield. That spread reflects things like credit risk and prepayment risk in the mortgage market. All these moving parts explain why mortgage rates don't always move in tandem with the Fed's rate cuts. For example, the Fed made 3 quarter-point cuts in late 24, but 30-year mortgage rates stayed high and even increased during that period. The reason is that fixed mortgage rates respond more to the bond market's outlook on inflation and economic growth than to the Fed's short-term rate directly. This time around, after the Fed's latest announcements, bond yields eased down, which helped pull mortgage rates lower. In fact, mortgage applications surged nearly 30% last week as many homeowners rushed to refinance the high-rate loans into cheaper ones. However, this window of lower rates could close if inflation or other economic data heats up. A surprise jump in inflation can push bond yields higher, and mortgage rates would rise in turn. In other words, positive economic news or renewed inflation fears can outweigh the Fed's cuts and send rates back up. What it means for you. Lower mortgage rates can be good news, but the key is to align this opportunity with your personal goals. Consider these scenarios. Home buyers. If you're in the market for a home, get approved for a loan and keep an eye on rate trends. When rates dip to a level that fits your budget, consider locking in that rate. It could save you from future surprises if rates rebound. Pre-approval and rate lock can give you more confidence as you house hunt, knowing your financing is secured at a comfortable payment. Homeowners. If you already own a home and your current mortgage rate is much higher than today's rate, it might be worth exploring a refinance. By refinancing, you could swap out your expensive loan for one with a lower interest rate and reduce your monthly payment. Just be sure the savings will outweigh the closing costs. A common rule of thumb is to aim for roughly a 1% lower interest rate than your existing loan to justify refinancing the cost. Run the numbers. If the refinance saves you money over the time you plan to stay in the home after accounting for closing fees, it's likely a smart move. The bottom line is that the Fed's cut has opened a helpful window, but mortgage rates take their cues from the broader bond market, not directly from the Fed. Understanding how those forces work, from the 10-year Treasury to the MBS market, helps you decide the right time to act. If you want to see what today's numbers mean for your budget or buying power, reach out. We can crunch the math together and find the smartest step for your situation. If you have any questions about this or about buying or selling real estate in Southwest Florida, just hit me up and we will make it happen.